Hi, everybody. Here we are for you Wednesday morning. Stephen Mead with Domicile Real Estate for people of houses. This is our Southern California housing market update for July 20th, 2020. That's when our data is through on this. And the title is not clickbait. I think we've got good news for everybody, whether you're a buyer, a seller, whatever your situation is. I actually think I have some good news in the update this week for you. I think there's been a lot of things talking about on the internet about a market that's shifting. I think we've kind of seen some things over the last few weeks. And in fact, really, if you take a look at the data, and we'll go through this, we've seen some more gradual efforts that have really been going on the last couple of months. I think if we were to look at when was the craziest part of our market, that was sort of in that March, April timeframe. And the term that I've used a lot, and I think it's still accurate to describe that period of the market, is when it is like a circus out there, kind of just with sort of nothing really making sense, lots of illusion and tricks and all kinds of other things. So I want to jump into the numbers with you and kind of go through what I'm talking about and what this really means for you if you're someone who's in a position to be making a real estate decision, because I think that's kind of always really what we've tried to focus on, is having information to make better decisions and have a better decision making process. So what I am going to do here is we're going to go ahead and we're going to go through and go into our stats here. Let me bring these up for you. Oh, looks like if I don't do this right, we don't end up getting, there we go. Okay. So let me back this up here a bit. For some reason, when we start this, it puts on the last slide. So let's talk about our inventory really for a minute, because I think that's kind of where a lot of this starts. If you're a buyer or a seller, I think it's probably the number one thing that sort of affects what you're doing and what you're going to experience. So just as a reminder, this is LA and Orange County, and we have both under 1 million and 1 to 2 million. And this is total active listings in Los Angeles and Orange counties. And if you look here, in the new year, we were kind of right around this 5,000 mark. And then starting here in April, you actually started to see this kind of growth and incline, right? And despite this dip here, if you were to draw a straight line across, we end up right where we are here in July. And that is right about 6,000 units for under $1 million. So, that's roughly a 20% increase in inventory under $1 million across the whole market. That is actually really huge. And you'll notice here that it's actually started leveling off, right? Like, so we kind of had a drop and then sort of this acceleration. I think some of this is related to the holiday. There's kind of some artifacting, but if you were to draw a line in between here, I think the trend line is pretty clear of where we are. I think 6,000 units is a bit of a new normal. That is more than we have had at any point this year. So I think if you're a consumer, that's really some great news. Now, we see something kind of similar over here for our 1 to 2 million. Obviously, there are fewer $1 to $2 million houses just in general in the market versus under 1 million. And again, we noticed the same thing. We got to right around here towards the end of April, and then we started to see this kind of upward slope, dip, and then kind of as if nothing had changed. And while these are much smaller increases, I still think, we're looking at about a 15 to 20% increase in inventory in this $1 to $2 million category. So obviously, if you're a buyer out there, this is absolutely 100% good news for you. If you're a seller, maybe not quite as good news for you, that you have more competition out there. But I'm going to talk about really why our overall market is still a better place for you as a seller than I think it was 2 or 3 months ago. Okay. So moving on, let's look at our new listings that have come up. I think this is really some other encouraging news. And, I was listening to an economics podcast. I'll kind of go through this. I was listening to an economics podcast, and I don't agree with this statement, but I heard it a couple months ago. And this economist said, "I'm waiting for the moment, and I have faith that the market will start behaving like a real market where it is subject to supply and demand influences." And I don't agree with that. I actually think we have been in supply and demand influences the whole time. But I'm going to tell you what's changed when we look at this graph, right? And one of the things that we've been just talking about really since the pandemic began was just this lack of new listings coming on the market. Things accelerated a little bit here, and then they were just stuck in this range, right? Now we're close to 4,000, new listings a week, right? And that's really a big number. And here's what I think's changed. If you look down here on 1 to 2 million, same thing, right? We've hit a new high for new listings showing up in the last 2 weeks. And what I think really is what's changed in this is I think a lot of sellers who were on the sidelines about listing their home, not because the prices weren't high enough, but because they were worried about what they were going to buy and whether they would even be able to buy anything. I think some of those sellers now have some confidence that if they put their house on the market and they get a buyer, that they can go out there and find a replacement property. And I think when sellers have that level of confidence, they're more likely to put their homes in the market. And that's what we're seeing here. Now, of course, this is our supply side of our supply demand equation. We want to look to at what is our new escrows. So, this is a little bit interesting here. We did see a drop, and I think we talked about some of this being related to the holiday, but not all of it. And I think that's turned out to be true, right? We hit this bottom and then we bounced back up in the last week. We're now at a point where we are beyond really sort of July 4th effects. We're still a little bit lower than I think where we've been throughout the spring in terms of the number of new escrows. And, one of the terms I've used a ton, right, probably for the last 9 months, I've used this term supply constricted market. I'm not so sure we're in a supply constricted market anymore. And I'm going to tell you a little bit why. We've got another graph that to me cements that. But what I'm seeing here is I'm seeing that, demand is a little bit weaker. And to be honest, this graph I think is a little misleading. If we were supply constricted through here, it means that really these numbers would have been even higher had there been more houses for sale. So you might be looking and saying, wow, we were at this constant level of demand and then it's dropped a slight amount. And I would say, no, we actually were at a much higher level of demand earlier in the spring, but there were no houses for people to buy. So it didn't show up in this chart. What I'm seeing here is what I think is a very natural effect. And that is, I believe consumers make decisions based on affordability for their family, especially in that under $1 million range, right? Like if you are a potential home buyer, you're going to look and you say, well, what could I rent? What do I give up? You're going to make this comparison. You're going to say, what's happened to my wages? My wages gone up. What is my payment on this house? You're going to evaluate these things and you're going to make a decision. I think a year ago, July of 2020, I think the decision to buy a home at all was so much of a no-brainer if you had steady income. If you were not worried about your job, the decision to buy, relatively speaking, home prices were very low, right? I think that was a no-brainer. And I think as prices have edged up in a very, it's been dramatic when we've been in it, but the reality is the graph is pretty linear for these things. I think what's happened is now we're reaching a little bit more of an equilibrium point, right? Like where consumers are kind of bouncing on the ceiling of affordability. And I have another chart where I think we can see that's clearly happening. And I think that's why we're seeing a little bit of this demand temper. It's not dropping demand. I think it's important to make that distinction. But I think it's a point where, yeah, we're starting to see supply and demand come into a little bit more of a balance. And ultimately, I'm going to explain why that's actually really good for sellers in the long run. I'll go over that a little bit towards the end here. But kind of heading back into the data. So, we see kind of a similar but obviously less pronounced effect on our $1 to $2 million price range, a little bit of a drop, a little bit of a rise back up. That one is still trending at kind of these levels where it's been. I think the real graph that sort of shows this relationship though is here. So if you look on this chart here, we've talked about some metrics of these zones, right? And I think in the past I've said anything above 90% is just insanity. 80 to 90 is a very strong seller's market. 70 to 80 is a seller's market. And I would say 60 to 70 is kind of more of a equilibrium type market. And if you look at that, where we are in our absorption rate, where are we right now? Well, we're in kind of the low to mid 70s for our under 1 million market. That is a seller's market, but not a super ridiculous one. And then if you are in our $1 to $2 million range, I think, there you're kind of in a market that's at the high end of equilibrium, crossing into a little bit of a seller's market. I think that's where we are going forward today. Obviously, your individual property geographic zone may vary. If it's a very hot area and there's only one house for sale, you're going to get multiple offers on that house and it's going to get bid. That's just sort of a reality of that scenario. But I think if we're looking across the market as a whole, I think especially in that 1 to 2 million range, we're not going to see a bunch of multiple offers on every single house, right? And the one thing too that I want to caution you about when you look at this is that this is a whole market metric. And what I mean by that is we're looking across not only all geographies, but all levels of property desirability. I'm going to go off the share and I'm going to talk about property desirability as sort of a continuum. Because in the past, when we were in an inventory constricted market earlier in the spring, I think we all saw the meme. It showed a plastic playhouse and it said new listing coming soon, $299, right, on it. And, the joke was that people would buy anything, right? They wanted a house, any house. We are now in a market where that is not true. And so if you are a seller, here's what you want. If you're a seller, you want to be one of the top 20% listings, meaning in desirability. If there's 5 houses for sale, if there are 10 houses for sale, and you were to rank them 1 to 10, right, first to last, if you were to rank those houses, you want to be 1 or 2. And here's the reason why. In this market, the house that is 1 or 2 position, the top 20% of the listings are getting 80% of the offers and the attention. Before, all the listings got attention, right? Now, the top 20% of listings get 80% of the attention. So if you're a seller, that really is the position you want to be in to be the most desirable and to really get the most attention. So practically on the ground, that means our advice tends to be to do more of those projects, to do more of those things to get a house ready for sale. Your return on investment is better now than it would have been 4 to 5 months ago. Okay, so let's jump back in here. Jumping back in here, if we kind of move beyond to our closed prices. Now, remember, these are based on contracts that were negotiated 4 to 6 weeks ago. That means the market we see today, which I predict will be a fairly flat pricing market, that market will show up in 4 to 6 weeks, right? Maybe 3 to 4 weeks. But look at what we have here. We have our high end of our market. It dropped a bit and then bounced back to kind of this level where it's sort of been in this range for the last 2 months or so. Same thing here. And then our bottom entry level market has actually gone up a little bit. And I think that's due to some strength in the condo market, because that's kind of that 25th percentile is really influenced by a lot of condos in LA and Orange County. Okay, so this is our percent still active after 14 days, meaning we look back 14 days, we say everything that came on the market in the last 14 days, how many of those listings are still around? I told you don't be alarmed by the giant jump that we saw last week. Turns out I was right. Look what's happened. Both of these numbers have tanked a bit. I do think there was kind of some holiday influence in that number. But if you look here at the trend, right, we saw things hit a bit of a low, sometime in March. March, actually end of February here for our under 1 million. And then we've seen kind of this, if you look at this trend line, kind of a steady growth, right? Like, I think people feel like markets turn on a dime, but the reality is when you look at the data, they don't. This kind of softening has really actually been fairly gradual and kind of hit up to a point we can sort of see that in the data looking backwards. Now, this one is still a little puzzling to me. I feel like our 1 to 2 million list to close ratio, boy, that luxury market, people just said, we will write whatever, we want what we want, and we'll do whatever it takes to get it. I'm glad to see a little bit of a reduction here under a million, that we are less than 104% of list price. I do believe that we will have sort of what I call the greedy seller effect take hold. And the greedy seller effect says this, that you look at whatever your neighbor sold for and you just say, I want more than that. And I'm going to assume that I'm going to get more. So, if your neighbor sold for $900,000, you put your house up at $949, expecting to get it. I think that behavior will cause a drop in these close to list ratios, and you just wait. In about a month, we're going to really see that in here. And I think this number is going to settle. The historic number for this is actually between, is around 99%. I think we're still going to be above 100%, but you watch, this number will start to come down. That is my prediction. Now, again, one of the alarming things that we talked about last week, and I said, don't be alarmed by this, was kind of a jump in days on market. And I said, look, I think this is an artifact of that holiday weekend. Bear with me. And lo and behold, what's happened, that days on market has dropped back to a normal level. Now, I think it's hard to call anything normal under a million. We're still looking at sub 20 days. And 1 to 2 million, that's grown a little bit, but I mean, still, we're less than 30 days in that luxury market. I do think these numbers will inch up. I think they'll inch up fairly slowly, but I do think we're going to start to see these numbers head in an upward direction a little bit over the next month or so. This is one of my favorite charts, and I'm gonna talk about this chart, and then I'm going to launch into why a cooler market is better for buyers and sellers. So one of the things that we've really spent time talking about is this notion that consumers make decisions based on affordability. And this is the payment on a median priced home. So this incorporates not only home prices, but prevailing interest rates. That's really important to understand that. And then we reference this back to 2018 to June. So June was sort of our baseline. And if you look, boy, in June of 2019, it was cheaper than it was. In June of 2020, it was cheaper than it was in 2018. And then things started going up, right? And they sort of accelerated to this 115% level around the end of March. And then we've really been bouncing in this zone. And I want to tell you, to me, what this means is that we actually have a little bit of stability in our market. And, as an agent, I will tell you, I like markets with stability a lot more. I think it's easier to give our customers advice. I think our customers feel better. Our clients feel better about what they're doing. And to me, this is our insurance policy against sort of a gigantic crash, right? And I think that's the concern that everybody has. And so when you look at this number, what I wouldn't want to see is that this number just kept heading to the moon, because I can tell you, wages have not grown more than 20% in the last 3 years. They have not. I do think wages have grown 10 to 15%. I think that is very realistic at this juncture, and I think that's what's gotten us to this point on pricing. So I like where we are on this affordability matrix. I like being in this zone. I think in order to break out of this 120% number versus 2018, I do think we're going to have to see either rates are going to have to drop more, or wages are going to have to go up by appreciable amounts. So seeing this stability, seeing the market ride in this range like this is very good news, I think, for buyers and sellers. Finally, in here, we did throw in sort of our prevailing mortgage rates chart here. Obviously, in the middle of last year, the pandemic, things were, in the middle of last year, things were pretty low on this front. As we kind of went this year, they rose a little bit, they came down, and they've kind of settled in this level. We've had a couple pretty good weeks here that we haven't seen since February in terms of prevailing mortgage rates. I think that's fueling kind of a lot of why the market still feels maybe a little bit busier than it actually is. So I promised to talk about why I think this market is really good news for sellers. Number one, I have never seen a higher fallout rate than I've seen in the last 6 months, meaning homes that do not close with their first buyer. Meaning that the first buyer goes in, they pick an offer, and it falls out, and they have to go to another buyer. I mean, it's nuts to me how common that has been. And I think if you're a seller, especially if you're a seller selling one house and trying to buy another, that is just a roller coaster ride of emotions and it's not fun. So I think that kind of behavior is easing up. I also like a market when it feels a little bit more transparent, when buyers aren't acting out of desperation and sellers aren't acting out of greed. So I see us moving to a market that feels, like I said, this feels like a seller's market, but not an extreme seller's market anymore. And I think that's actually a pretty decent place to be. I'm also relieved, as I mentioned, I'm very relieved that prices are not just accelerating to a crazy level. And the reason why is because when that affordability gets way out of whack, that's when you start running that risk of sort of dramatic downward market movements. Because then you have a market that's sort of out on this precipice on its own, where prices get accelerated to a point and then they fall, kind of like a plane that has just gone up in a stall and can't make it anymore. And I don't see that happening. Instead, I see this kind of like we have reached sort of a bit of a pricing plateau. I think that that's kind of a great place to be. If you're a buyer, this means you're locking in low interest rates. Are you maybe disappointed that, unlike your friends who bought last year and got sort of a 25, maybe even a 30% price increase in that period of time, that you didn't get that too? I get that. I understand that. But I think in the long run, given where I think rents are going, I think anybody who is buying right now is going to be happy with their decision 5 to 10 years from now. If you're a seller, I think, crazy markets might seem fun. You feel like the belle of the ball when your home gets 25 offers on it. But the reality is there's a lot of stress in picking a buyer. Are you picking the right buyer? Buyers will tell you anything to get their offer accepted, whether it is true or not. They will lie, they will do whatever. So I think that this market that feels a little bit closer to just a normal seller's market is really a much better place to be. If you've got a great house, it will get attention and it will get sold if you have a compelling proposition in the market. So, homes are still moving very quickly, as we've seen by days on market. But understand it's not a given. You can't just take your broken down shack and put a for sale sign out front and have 10 offers by the end of the day. That's not the market that we're in anymore. Anyhow, thank you guys for watching. You really do want to like, subscribe, and hit that notification bell. We're looking to add kind of some extra content that we're not going to be publishing on Facebook, kind of some fun content with architectural homes. So keep a lookout for that. We also have our first time buyer market update, which comes out on Fridays. So we will see you again for that. As always, we love questions and comments. And if you have any real estate questions, or if you're looking to buy or sell a home here in Orange or Los Angeles counties, definitely reach out to us. We'd love to work with you, and we will see you next time.